Friends, this is CA MK Corp and I am bringing before you the one of the most important part of management accounting, that is your break-even of EBIT. We all know that break-even is a point where there is no profit, no loss. In marginal costing, the concept of break-even is very popular, where sale is equal to cost and there is no profit, no loss. Similarly, in the management accounting also, this break-even is very important, where the level of EBIT, where the EPS of both the firms are equal. So break-even is the level of EBIT, earnings before interest and tax, where the EPS, earnings per share of both the firms are equal. So if we think of the break-even, break-even means it is a point. Break-even means is a point, is a level of EBIT where the EPS of both the firms are equal. This is the level of break-even. Here we have considered one levered firm, one unlevered firm. Levered firm has a debt. The capital structure of a firm, if we think of a capital structure, suppose this is your firm A, and this firm A has got only the equity share capital, equity share only. There is no debenture, no debt, no term loan, no long-term loan, only equity is the capital. This is your unlevered firm. Here no debt is there, therefore it is called unlevered, no debt. And it is called unlevered firm. Right? Similarly, if we take another case, this is a case of firm B, and in case of firm B, there is equity capital plus debt, and this is called levered firm. Levered firm. So in case of firm B, the capital consists of equity and the debt. Since there is a debt is here, we call it as levered firm. And in this case, there is no debt. Therefore, this firm is called as unlevered firm. Right? And if we go through this particular graph, we will see firm B is your levered and firm A is your unlevered. And in this case, the unlevered firm has the EPS here and levered firm has the lower EPS. So in the first phase of the farm, मान लीजिए if you think of the A and B both have started business. In the first phase of the business, the liver farm has a lower EPS and the unlivered farm has a higher EPS. It can be known from this graph. The unlivered farm has a higher EPS and the livered farm has a lower EPS. But as they go on producing more and more, selling more and more items, they reach at a point where the EPS of both the farms are equal. So break-even is a point of EBIT, is the amount of EBIT, is the level of EBIT where the EPS of both the farms, both livered and unlivered farm, has got equal EPS. This is your equal EPS. That is called the break-even EBIT. Right? And if they produce again more, they go on producing more at a higher level of rate of return. The livered farm, EPS of the livered farm is higher and the EPS of the unlivered farm is lower. Therefore, suppose if you think the rate of interest of a debt is 10%. So if you borrow the money from the bank will charge you 10%. If you borrow money from the public like debenture, you have to pay the interest 10%. So rate of interest of debt is 10%. But if I use the money, if I invest the money, if I circulate the money in the business, I will get 15% return. That is called internal rate of return. So my return from the project is 15%, whereas I am paying 10%. So the balance 5%. 15% is my R, that is your rate of return. And my cost of debt is 10%. So 5 rupees is my return. 5 rupees is the surplus per 100 rupees. And this surplus will increase the EPS. This surplus will increase the EPS. Therefore, in a higher level of production, higher level of return, livered farm has a higher EPS than the unlivered farm. So sometimes it is called that taking loan for a efficient management is a better option. Taking debt in the business is a better option for the efficient management who earns more than what they pay. So in this case, the earnings of the rate of return on investment by the business is 15 and the cost of debt is 10. So there is a net savings of 5. And this 5 rupees out of 100 rupees investment will go to your increasing the EPS of the farm. Therefore, that the livered farm has got the advantage over the unlivered farm so far as the earnings per share is concerned. And if the EPS becomes more, the share price, the value of the farm will increase at a faster rate. So let us come to the break-even. How the break-even can be calculated. So friends, this is your sales. If we take this is your sales minus variable cost, this is your variable cost, this is called contribution, and this contribution, as you know, the excess of your sale over the variable cost, this is contribution. And if we minus the fixed operating cost, it comes to your EBIT, right? From the EBIT, if we deduct interest, then we will get EBT, earnings before tax. And from this, if we deduct tax, we will get EAT, earnings after tax. And if we deduct the preference dividend, PD, preference dividend, then we will get EAES, earnings available for equity shareholder, right? This is the earnings available for equity shareholder. EAES, earnings available for equity shareholder. And if we want to calculate the EPS, earnings available for equity shareholder divided by number of equity share, that will give you the EPS. So let us start. Explain you. Sales minus variable cost is the contribution. Fixed operating cost, if you deduct, you will get the EBIT. And after getting the EBIT, interest will be deducted, because the interest have to be paid if there is a lever firm. So after paying interest, the EBT will be here, earnings before tax, and if we deduct the tax here, tax is deducted here, and we will get the EAT. From the EAT, if we deduct, this is your interest. After you make a interest, it is EBT. This is your tax. This is your EAT, and preference dividend. If you deduct, then this is your EAES, right? This is your EAES. This is your earnings available for equity shareholder. Suppose in a firm there is no preference dividend, no preference share, so this will be nil, and EAT and EAES are same. Let me tell you, that is, suppose the EBIT is 1000, interest is 200, we will get 800 here. This is your EBT. And if the rate of tax is 50%, tax 400, we will get EAT 400. From the EAT, if there is no preference dividend, then EAES is also 400, right? So in this is the basic structure on which we calculate the EPS. Now we will design the break-even of the firm. So let us start with the firm A. Firm A. The firm A was unlevered firm. So in case of a unlevered firm, if we start with your EPS, how to get the EPS? EBIT, this is EBIT, less interest, less tax. So if I multiply this with 1 minus tax rate, then this will be EAT, earnings after tax, EBIT minus I. We reach here EBT. EBT after tax, 1 minus tax, that will reach here EAT. And there is no preference dividend. Preference dividend is 0. So this is EAT divided by number of equity share. N1. This is your number of equity share. So N1 is the number of equity share in firm A. So this will give you the EPS of the firm. Right? The concept has come from this particular thing, that is EBIT minus I minus tax, that will be your EAT, and there is no preference dividend. As I have told you, this is 100% equity oriented firm, and number of equity share is N1. So earnings available for equity shareholder divided by number of equity share, you will get the EPS. This is your EPS. Similarly, in case of firm B, if we take the firm B, we will take EBIT, and we know the interest is here. In the first firm A, I will be 0 because there is no interest, there is no debt, no preference share. Here there is a debt is there, EBIT minus I, 1 minus T, right? And divided by, there is no preference dividend, no preference share in case of firm B. So minus PD, you don't have to write the minus PD because there PD will be 0. Here this will be 0. Here also there is no preference dividend. So here this will be N2. Number of equity share, N2 is the number of equity share of firm B. Right? Here, then what is the difference between these two? Here I is 0 because no interest, no debt. Here there will be some interest. And here number of share is N1, and here number of share is N2. Now if we equate these two equations, we will find out that is EBIT minus I 1 minus T divided by N1 is equal to EBIT minus I 1 minus T divided by N2. And we do not know the EBIT here. We can take it as X. And in the first farm A, I will be 0. So what will be the equation here? This will be X 0, X minus 0 if we take EBIT as X. Taking EBIT, because we have to find out the EBIT, so let us put it X into 1 minus T. This is X. I is equal to 0 because this is a non-levered farm, unlevered farm, and 1 minus tax rate divided by N1 is equal to your X. Here I will be here because it is a lever farm. X minus I 1 minus T divided by N2. By solving this equation, we can find out the value of X, and X is the level of EBIT, where EPS of both the farm A and farm B are equal. So friends, let us start with solving the problem, taking one unlevered farm and one levered farm. So this is the problem. Farm A has 1 lakh equity share of 10 each, that is capital is 10 lakh, 1 lakh into 10 lakh. Farm B has 50,000 equity share of 10 each, so equity capital of farm B is 5 lakh and 12% debt of rupees 5 lakh. So in case of farm B, there is capital is 10 lakh. In case of farm A also, capital is 10 lakh. Find the level of earnings where EPS of both the farms are same, provided rate of tax is 50%. We can take 40%, 30% as the case may be. So one farm A has only equity capital, so it is a unlevered farm. Farm B has equity plus debt, therefore it is a levered farm. So if I write, that is EBIT, I am writing farm A, EBIT. I is absent. In case of farm A, there is no debt. So no debt means there is no interest. So EBIT 1 minus tax rate, 50% tax, 50 by 100, that is 0.5. So if we multiply this with 1 minus 0.5, it will be after tax. And there is no preference dividend, divided by number of equity share, this is your 1 lakh. And in case of farm B, EBIT minus the interest. The interest is 5 lakh into 12%, because in case of farm B, there is a debt is here, debt is carrying 12% interest. So 5 lakh into 12%, it comes to your 60,000, right? Into 1 minus tax rate, that is T, divided by number of equity share. Number of equity share in case of farm B is 50,000 equity share here. in case of firm B. Now taking EBIT as X, we can solve this problem equation so that we can find out the EBIT where EPS of firm A and EPS of firm B are equal. So let us take EBIT equal to X. Okay, so this will be X1 minus 0.50 by 1 lakh equal to X minus 60,000 into 1 minus 0.50 divided by 50,000. Now if we this 50,000 and 1 lakh, this will be only 2. So 50,000, here it is 1 lakh, we can take 2 here, this will be 1. So now X 1 minus 0.5, this will be 0.5, so this will be your 0.5x. 1 minus 0.5 is equal to 0.5, 0.5 into x, that is your 0.5x divided by 2 is equal to x, this is 0.5 into x, 0.5x, so x minus 60,000 into 0.5 divided by 1. This is 1. Now if we multiply this, and we can 0.5x by 2 is equal to 0.5 into x, 0.5x minus, this is 30,000, 60,000 into 0.5, this is 30,000, so 0.5x, we can make a cross multiplication here, 2 into 0.5x minus 30,000. This will again 0.5x, this is x, 0.5 into 2, that is 1, 1 into x is x, minus 60,000. So if we take the x here, this will be 0.5x minus x equal to minus 60,000. So if I write here minus 0.5x equal to minus 0.5x this is 0.5x minus x minus 0.5x equal to minus 60,000, right? And if we cancel minus, x is equal to 60,000 divided by 0.5, so 1,20,000 is the EBIT. So if EBIT is 1,20,000, if EBIT is 1,20,000, then both the firms A and B, unlevered and levered, will have the same EPS. This will be your answer, and we can also verify this. Let us verify. EBIT is your 1,20,000 here, here also 1,20,000 less interest, here it is nil, here it is 60,000, this is EBT 1,20,000. This is 60,000 EBT less tax. Tax is 50%. It will come to 60,000. Here it is 30,000. So it comes to 60,000. This is your EAT and this is 30,000. Number of equity share. Number of equity shares. Here it is 1 lakh. Here it is 50,000. So EPS here 60,000 by 1 lakh. This is 0.6. 60,000 by 1 lakh equity share. This will be 0.6. 30,000 by 50,000. This will be also 0.6. So EPS of both the firms are remaining same as we have verified it. Right? So in this way we can verify and check also. So 1,20,000 is the level of EBIT where firm A and firm B has the same EPS. Let us confirm, let us again do the another one problem where there will be preference share. So let us come to the next problem. So this is the problem. This firm X and firm Y. Firm X has 1 lakh equity share of 10 each and 10% debt of 5 lakh. Firm Y has 50,000 equity share of 10 each, 12% debt of 5 lakh and 10% preference share of 5 lakh. Find the EBIT where EPS are same or indifferent. So friends, this firm has equity and debt. You can say debenture, you can say term loan. In this case, there are three things: equity, debt and preference share. So if we take into account the firm X here, and in case of firm X, we have to take EBIT minus I, because there is a debt is here. Here I am writing rate of tax, say 50%, and 1 minus T. There is no preference share here, right? There is no preference share here, and number of equity share is 1 lakh here. Let it be N1. In case of firm Y, EBIT minus I, because there is debt is here, 12% debt, 1 minus tax rate minus preference dividend. Here there is preference dividend is also there, divided by N2. Here N1 number of equity share is 1 lakh. In case of firm Y, number of equity share is 50,000. So friends, how to find out this problem? Let the EBIT be X. As we have taken in the earlier problem, EBIT will be X. So let us take it X. X minus I. How much is the interest? 5 lakh is the debt. My debt is 5 lakh. 5 lakh into 10%. It comes to your 50,000 into rate 1 minus 0.5. That is your rate of tax. So tax rate is 50%. 50 by 100, that comes to your 0.5, right? And divided by N1. N1 is the number of equity share. Number of equity share is 1 lakh. Here there is 1 lakh equity share is here. Then if we come here, this will be X minus I. Here debt is 12% debt of 5 lakh. So 5 lakh into 12%, this comes to your 60,000. EBIT is equal to X, I is equal to 60,000, 1 minus 0.5 minus PD. PD is your preference share, 10% preference share, so 5 lakh into 10%, it comes to 50,000. So 5 lakh is the preference capital and 10% is the rate of dividend on preference share. So 5 lakh into 10%, preference dividend comes to your 50,000 and number of equity share is 50,000. And we have to find out the value of X, and that will be the equilibrium EBIT. So if we did, this will be 2 here, right? Now I am writing here, so this is X minus 50,000 into 0.5 divided by 2 is equal to X minus 60,000 into 0.5 minus 50,000 divided by 1. And now multiply this 0.5 into X, this is your 0.5X. 0.5 into 50,000, it comes to 25,000 divided by 2 is equal to your 0.5 into X, this is 0.5X. 0.5 into 60,000, this is your 30,000. 0.5 into 60,000 is 30,000 and minus 50,000 preference dividend. This is your preference dividend PD. This is your preference dividend. That is 10% on 5 lakh. Divided by 1, and it comes to your 0.5x minus 25,000 is equal to 2 into 0.5x minus 80,000, right? So if I come here, 0.5x minus 25,000 is equal to 1, that is your X, minus 1,60,000. So 0.5x into 2, this is your X, 2 into 80,000, 1,60,000. Now let us take the X left hand side, 0.5x minus X, this is 1,25,000 minus 1,60,000. So this is 0.5x minus, this is your minus 1,35,000. 1,60,000 minus 25,000, 1,35,000 minus cancel. 0.5x equal to 1,35,000 and X will be equal to 2,70,000. 1,35,000 divided by 0.5 at 5. 1,35,000 divided by 0.5. This will be X will be 2,70,000. So EBIT will be 2,70,000. So EBIT will be 2,70,000, where the EPS of both the firms will be equal. So EBIT 2,70,000, where EPS are equal, right? So in this way we can calculate the break-even EBIT at for the different problems, and I hope these two problems will help you a lot in the exam. If you like the video, please subscribe and offer your comments. We will be coming out. This is the chapter on leverage. Of course, this particular thing is separate from the leverage, but I have taken out here. But we will again come to your different chapters, and all the chapters will be clearly discussed before you. And if you want to subscribe, you can subscribe and offer your comments. Thank you friends.